if we have a rate reduction, what do you think this could do to property prices?
Yeah, look, this is obviously at face value. If there is a rate cut and it's passed on, there's a cash flow effect to the
let's talk about the pass on.
Yeah.
What's the normal convention?
The normal convention.
Let's go back 20 years.
Yeah. If the RBA hikes or cuts, but we'll talk a rate cut, they cut 25 basis points on the official cash rate. The banks pass it on to depositors and to borrowers.
So pass a lower interest rate on to deposits.
So if you've got a term deposit at 4.5%, it'll probably reduce to 4.25%. If you've got a mortgage at 6.4%, it drops to 6.15%.
Yeah.
Normally just passes through. Back in the day, conventional wisdom. I know we're in a very very competitive and a very problematic market for mortgages
and
right now.
decoupled.
Yes. And so there's a whole lot of other things going on in the mortgage market. So that old way that we used to get that transmission from an official rate to the actual rate that people paid was pretty simple, pretty straightforward. Now with different sorts of mortgage, fixed and floating and 2 years and a mortgage offset account, I'm telling you nothing. There's a whole lot of different mortgages you can take out. So, and they're all priced differently. And they're all priced investor, owner, occupier, interest only, 25 years, 30 years. So there's, I don't know how many mortgages there'd be. There must be dozens. And they're all priced from a different set of inputs. They're largely the same, but there's a few different inputs and a different risk assessment. Is this loan a little bit more risky than that loan? So they're all priced slightly differently. So to say that, this is going to be pretty much a straightforward pass-through of 25 basis points across the board, probably won't happen. Well, it'll be on the standard variable, they will, but I don't know how many people have a standard variable rate anymore. It's a smaller proportion than back in the old days where everybody had a standard
what worries
rate.
me though? Just on that point, the vast majority of borrowers in Australia have variable rate, as you know, these days, and I think that the banks have been. I think there's going to be a debate. The banks have been chasing, because interest rates have been high and the market growth has been low. The banks have been chasing market growth against each other. So banks have been operating very tight. What I mean by that is they've been pricing very tight. In other words, not baking much margin into their loans. And the banks have been sort of not loss leading, but not too far away. There's not a lot of money in it. So 80% of the lending for prime loans just covers your cost. 20% makes money. And they're making the money in the big loans, the $1 million, $2 million loans, the big loans that they're making to people who've had a job for 5 years. There's no risk associated with them. They're making good money. They're only borrowing 65%. They're not borrowing 80% or whatever the case may be, etc. That's the big loans. That's 20% of the market. The other 80% of the market, there hasn't been a great deal of profit sitting in it. And the banks have an obligation to their shareholders to maximise profit.
Sure.
Now, and I'm not suggesting the banks act all at the same time, because they don't. They're all competitors and they all got to make their own decisions. But they're all stricken by the same issue. They haven't been making money on a vast proportion of their new lending over the past 5-6 years. Bear in mind that the government funding policy that came in during the Liberal Party government during the COVID period, these banks have had to pay all that back.
Correct.
That
0.1 term funding facility.
The TFS, whatever it is.
TFF, term funding facility.
That has to be paid back, and they're paying it back, and I think it has to be paid back by the end of this year.
Yes.
So
that 0.1% money that they got, they're now rolling it over into 4 points.
Or sometimes they're hybrids. Some hybrids were issued at 6%, whatever.
Correct.
And so the cost of funds is quite high. So, I would have to question for those people listening to this, and people should just think about this. It may not be, whilst the Reserve Bank might do its job and, because they're happy with all the data that they're getting and they may reduce interest rates. I just think people should be careful that some banks might not pass on the whole 25 basis points, or they might wait.
Yeah. You've triggered something in my mind here. If you go to the rba.gov.au website, so the Reserve Bank of Australia website, in the top panel, there's the chart pack, which is a range of, 100 charts. Love it. You've sparked one that caught my eye when I was going through this over the summer holidays, as you do. towards the back, it might have been about the second last page, is a really simple chart, NIM, net interest margin,
and by the way,
of
that's
the banks.
critical to us. That for all of us is the most important number.
Correct. It's the most. There's a lot of important numbers in this economy. The net for the banks and the pass through of RBA rate hikes, rate cuts, all the rest of it. It is bloody important.
It's called the NIM, and it's actually called the NIM.
Yep. If listeners go to the RBA webpage, click on Chart Pack, and it's, as I said, it's about the second last page. There's a whole lot of stats on banks there, profits and stuff. But the one that hit me between the eyes was the NIM, and it goes back about 25 years.
Yeah, and it's been crushed.
And back in the day when Wizard came along, it narrowed.
Yeah.
So
it was 4 and it came down to about 2.4.
Correct. And then it's hovered around that up and down, a little bit up and a little bit down for years, because the competitive pressures are pretty good. Just the last couple of years, the last year, not the last couple of years, the last year, it's below 2%.
Totally
well
got
below
crushed.
2%. It's about 180 basis points, which, okay, that's what I think what you're alluding to.
Yeah,
is competitive pressure, a generally weak house price environment out there. We're all worried about, what's going on in the housing market. So the banks to maintain market share are, jostling with each other, which is probably good for consumers, but this is the but that I think you're getting to. When our friends at the RBA start trimming interest rates, the banks might say, "Oh, thank goodness for that. We might only pass on 10 basis points."
Yes. No, and I'm not suggesting a bank will do that, but by the way, it'll be a discussion they'll have in the Treasury Department. I can guarantee you.
Or they might do it on their high. They might pass through the full 25 on their, what do we call it, the high profile mortgage rate.
Or they might do it for new borrowers.
New borrowers.
They might just say new borrowers.
And for the old borrowers or the ones that have got a 30-year loan or whatever, they might just trim it 10, 15. 12, 15 and get that NIM, the net interest margin, back up another 5, 10 basis points.
And that's their job, by the way. That's their job to show us, because what they've got, the NIM represents the gross profit on their operations.
Yep.
Which is the reason why NIM, by the way, and a lot of people go on about how the banks have to, or closing their branches, et cetera, every day. Yeah. Well, part of that reason they do this is because they don't make as much money out of the mortgage. And people might say, well, I don't feel sorry for CBA because it makes $10 billion a year. But at the end of the day, the reason CBA makes $10 billion a year is they're making it a much lower NIM, just that so they've got such a big book.
It's just such a one of the issues about Australia's population growth is that when we talk about immigration impacting the whole economy, labour supply and all these other things, I dare say every immigrant who comes here opens a bank account with one of the banks, and they have transactions, and the banks make money from. They get a credit card, they get a loan, they get a car loan, they get a mortgage, and that it's just what do we call it? The critical mass or the economies of scale that the banks are operating. So you can sort of get a little
but they're not
bit
because
of
it's not because they're gouging people on the mortgage interest rate. That's sort of our point. And banks have an obligation to get a return on capital, return on equity is a big marker for how banks are priced. And Australian banks, by the way, have an unbelievable share value relative to other banks around the world in terms of total valuations. And this might be an opportunity for banks to take a little bit back. You and I shouldn't ponder too much on it, but I just wanted to raise it because I think it's an important point.
Correct.
The old days, they used to pass it on straight away.
What gets passed on. And just one other aside before we move on, the RBA will look at that too.
Yeah.
They want, because the official interest rate, no one other than the banks pay it, sort of thing. They want to get if they're worried about growth and low inflation or whatever their assessment of the economy is, they want the interest rate cuts to impact on the punters out there. They want them to get that cash flow. So if they deem that a rate cut's needed and it's not passed on, curiously, they'll probably cut a little bit more than the market's currently priced in if we don't get that pass through, because they want to see the $2 trillion of mortgages that are out there, give or take. They want to see people saving some money on that so they can spend, get the economy growing and keep that unemployment rate nearer 4 rather than going up to 4.5 or 5%.
So just so I don't want to sort of give everyone brain damage, but if I could just you said something quite interesting then to me. Why would the Reserve Bank reduce interest rates? And let's assume that the banks pass them on. and let's assume the pass-on effect is stimulation of the economy,
Yep.
When they think it's not too bad at the moment. I mean, why do they want to stimulate the economy? Is it about, Steve? Is it about stimulating the economy, or is it about stop punishing the economy?
The latter. Stop punishing the economy, and it's about where the economy is going to be in 6 to 9 to 12 months.
So they always talk about the medium term.
Because a rate cut today or on the 18th of February, if that's when we get it, will not impact the economy on the 19th of February or the 19th of March even. There is a little bit of a time that the banks and other institutions pass it on. Fair enough. It takes a little bit of a while to organise these things. And then for the borrowers to recognise the fact that it's been delivered. So again, assuming it's passed on, because so for someone who's got a big mortgage, they get the first rate cut in March or April on their scheduled repayments, because that's when their next repayment's due. They save, I don't know, $100, whatever that number is per month on their mortgage repayments. They might think, oh, that's good. And then in May, they realise a bit more. And then, finally, it's not because consumers are silly. They're not. They're very, very astute. But it takes a while for that lag between when I pull the trigger on a rate cut and when it has its full effect on the economy. And it's been modelled 1,000 times, as you know, Mark. It's between 6 and 12-ish months. Sometimes it's a little bit longer if there's different things happening in the economy. But if you cut interest rates today, the full effect, there'll be a little bit of effect earlier on, but the full effect of that rate cut's not for 6 months.
Okay, that's
why the rate cut in February will have its impact in the second half, let's call it, of 2025 and into 2026.
In terms of responses and results. But
Correct.
what you've raised is why I wanted to go to this point. So because of the lag effect,
yep,
and who really knows how long it's going to be, but let's say it's somewhere between 6 and 12 months. In other words, before people start to feel the benefit of a rate reduction and or rate reductions, plural. Let's say it's, July, August, maybe longer, but let's say it's sometime in the second half of this calendar year. What's important about what you just said, and I think what we should express to listeners is this. Therefore, if that rate cut doesn't really drop into everyone's back pocket for a bit of time, then between the December numbers, which came out at the end of January, the read on inflation at 3.2, trim mean, underlying inflation, and the day that this money sorts of drop into everybody's pocket, the expectation of the Reserve Bank will be that the inflation should keep running down. In other words, it doesn't stimulate day one. So therefore, if it's on its way down, if they're convinced that interest rates inflation is coming down, by the time the interest rate reduction that they announced on the 18th of February has any effect, inflation is probably going to be down at 2.5%.
Which is why we haven't spoken about the futures market, which I do love. It's not always accurate. It's always accurate, but sometimes gets it wrong. But as we sit here this morning, I checked before we came in for the recording, we do have between now, early February, and the first half of 2026, so the next 15 odd months, which is where the futures are generally most traded, we have just under 100 basis points of rate cuts priced into the futures market. So the money market investors who trade these things and the banks who borrow the money and hedge their money on bank bill markets and all this other stuff are effectively saying, here and now, we think there's going to be 75, maybe 100 points of cuts between today and early 2026. So the official cash rate, 4.35 today, could be 3.35, 3.5-ish. Without putting a pinpoint accurate number on it. And to me, that's about right. And if the RBA, we'll see what Michelle Bullock says at her press conference in a week or two.
But can I just
she'll probably say that's a reason. I think she'd last. That's a reasonable assessment of what we might do.
That worries me a little bit, Kooky, and I'll tell you why.
Yeah.
Because if we look at what, the net zero proposition, if it's a 3.5, for argument's sake, let's say we get 3.35, 100 basis points worth of reduction, 3.35.
3.35, yep.
It's not zero because, there's no way in the world they're going to give us 100 basis points if they think inflation is going to be at 3.
No, that's right, correct.
It's got to be.
They need to see each number.
Yeah, it's got to be way, way lower than that. It's got to be 2.5 minimum.
Correct. And as I said, as we said earlier, they target to the midpoint of the target range.
Yep.
And for the odd quarter, if it's 2.7, they don't care. 2.3, they don't care. As long as it's roughly 2.5.
Yeah.
But we're coming from such a high starting point.
Yeah.
And here we are. We just sort of, hallelujah, we've got it down a bit. But again, we want confirmation. It's like leading the grand final 10-0 after 10 minutes. Great start, but you haven't won the game yet. There's a lot of teams playing against Penrith have found out the last few years. It's good start and you're happy as a fan of low inflation. You'll be thinking we're on track. But then the bounce of the ball goes the wrong way. Trump tariffs do something. China's stimulus measures, a myriad of things happen. We've got an election here probably in May. And by the way, I loved both of your interviews with Mr. Dutton and Mr. Albanese. They were sensational, so recommended for everybody who missed it because they were very personal, I found, and I thought they were,
They both did a good job.
But they were both good interviews, so just by the way.
No policy. But
no.
People.
But there will be policies involved with the election, of course.
Correct.
So Labor, Liberal, Labor, whatever, and, fine. That's what we're having a vote about, But that could come along and create some issue for the RBA. Maybe. I don't know. I'm just making this up at the moment. So that trajectory of 100 or nearly 100 points of rate cuts priced into the market, that can change. That can change very quickly as news comes out. And indeed, thinking back to that inflation number which came out at the end of January, a couple of weeks ago, that caused the market to rally and price. And before that, we only had sort of 2.5 rate cuts. So when that number came in nice and low and everybody was able to analyse it, oh, hell, we better reprice to 3.5 rate cuts being priced.
So just before we go to your table, do you think the RBA in their half-yearly review, which comes out in February or late February, I guess these days, when they after they have the meeting on the 80th, they usually
it comes out simultaneously now. That's the
same
other
day.
reform. Yeah, it comes out at the same time.
So we'll get the half-yearly review.
There's so much information that it's a dream for us economists.
Because she's going to be because she has been saying 2016
226 is the time.
Sorry, 2026 is the time when we're going to start seeing inflation in the right territory.
Yes,
so you reckon she will review that?
Bring that forward.
Right.
I was crunching some numbers the other day. I reckon they'll bring it forward by 6 months.
Wow. Yeah. So I think she was saying March 2026.
So I think they'll bring it through. She might be a little bit vague and say the second half of 2025.
Right. That's interesting. Very interesting.
So whether it's September quarter or December quarter, that was why, to just sort of hammer this point home, that was why when that December quarter inflation number came out, we saw the 0.5 trimmed mean more importantly than the headline figure. When it came out, people thought, wow. And I'm not throwing stones at anybody here, but even good old Warren Hogan, who I respect immensely, he came out and said, well,
no, Warren, he sent me a text, he said it's going to happen.
He said, gee, that's a low result.
Yeah.
And, he's as hawkish as they come.
And Chris Joy.
And even Chris, yes. So two people are really hawkish on rates, smart economists, they know their stuff as well as anyone, who were really hawkish, and fair enough. I'm not having a go at them for 1 second. But they've come out and said, well, gee, that number has made me rethink, just like I've rethought a whole lot of things in my life.
What happens in this game? Because data, you only respond to the data.
Correct. You have your view, you form your views, you craft an argument about rates up, rates down, GDP up, GDP down, all that stuff. And then a number comes out occasionally. You think, shivers, that was a big difference. I've got to change my view.
Yeah.
Or that reinforces my view, one or the other. And that CPI mark was so big that the interest rate hawks, the ones, we've got to hike, and, again, I'm not having a go at them. But they came out and said, gee, that's amazing. I've changed my view.
I said something on TV the other day. I said, good on Australians, because they have behaved in the way the Reserve Bank governor would like to see them behave relative to what's happened with interest rates.
Correct.
We've done it.
Inflation's down.
By the way,
the business sector's
I just want to be clear. It's no politician has done this. It's Australians.
Yeah.
We've done it.
And as I've said a million times, I'll say it till the day I give up economics, which is still hopefully 20 years away. Australians are smart when it comes to their money. I'm not just saying that because we are. And that's why interest rates are such a topical issue. I often mates in the US, why do you Australians talk so much about interest rates? It's because we love it. We've got mortgages. We want to buy a house. We've got our superannuation. You know, we're worried about, the market went down. And even though, if you're 35 years old, you can't get your super for another 30 years, or you've got a mortgage, you don't pay it off for another 20 years. We love this sort of stuff. And so that means that the discussion of interest rates and 25 basis points, if you've got a 25-year mortgage, 25 basis points is nothing in the scheme of your mortgage. But for today,
next month,
when you're forking out bloody thousands of dollars on your repayments and you get one rate cut, maybe another rate cut, and you listen to this debate and hopefully this podcast and whatever, and you think, gee, by this time next year, and here's a long time, we might get rates 75 or 100 points lower. Put that in your calculator. Fantastic. I'm going to save a couple of $100 a month. I'll be breathing a sigh of relief, and I might actually go out and spend a bit more money. That's why our Australian consumers, when they saw the rate hikes, turning it on then, went, oh my God, consumer sentiment went through the floor. Consumer spending went through the floor. Retailers, under huge pressure. A lot of construction companies, oh my God, they got hit. And that was I'll call it tough love that happened. And now we've suffered the tough love. We're about to get some real love.